Hi, everyone. Well, I'm pretty sure we're not going to be able to top that, but we'll try to give you some insight on venture capital and innovation. I'm Vinod Sreesha, business reporter with the Miami Herald. How about each of you take a second to introduce yourself to the guests?
Sure. Hi, everyone. Joe Malchow. I'm not from Miami. I'm in Northern California. In the Palo Alto area, and I run a firm called Hanover Technology. We work on building new hardware and software companies, and have been doing that for about 15 years.
I'm Tomas Philipson. I am a Miami resident since 2 years back. I used to be a professor at University of Chicago. I'm not anymore. I was there for many years, 20 years. Then I co-founded a company that's in healthcare analytics. I spend most of my time in healthcare. That's currently owned by Blackstone. Sold it in 2015. Then I was a chief economist at FDA and CMS, and also served in the White House as member and chair of the Council of Economic Advisors.
Okay, great. I'm going to start by throwing out some data from kind of the past year. According to, this is data from PitchBook, the research firm, $170.6 billion was invested in venture capital in the U.S. Last year. That was 30% down from 2022, and about half of what was invested in 2021. And that's even including all the AI deals and hype, if you remember that, towards the second half of last year. VC also dropped significantly in Latin America. It dropped a lot in Miami. Seed deals were down. What I want to start with each of you is, I know each of you, I think if I recall correctly, each of you did make some investments. How would you compare the number of investments you made last year? Let's start with you, Joe. How would you compare the number of investments you made last year compared to the prior year, and what kind of investments did you make?
Okay, well, just since this is a panel and we want to be as controversial as possible, the premise of your question, it's down. VC allocation is down 30%. That's 2023 on 2022. It should be down way more. That there's way too much money in venture capital trying to do new build companies that, in most cases, don't need to exist, don't deserve to exist. So it ought to come down like 50 or 60%. When I hear stats like that, it reminds me of a very famous, in my head, New Yorker article from like 10 years ago. Actually, it was just after the financial crisis. And the headline of the article was, why have so many people lost money investing in restaurants in New York City? And because this guy had been to so many lovely restaurants, he goes with his friend invested some money in the restaurant, and of course, a couple years later, the restaurant is gone. That's what happens when you invest in restaurants. Anyway, it's a beautiful little article, but it ends with the moral of the story, which is that so many people do this precisely because they just want the experience of taking their friend to a restaurant and saying, this is my restaurant and I invested in this restaurant. And that's why there are so many great restaurants in New York City, because there are so many people ready and willing to lose money doing it. Okay, anyway, that's my reaction to the stat that you offered at the start of the question. For us, it's about the same. We make about 12 investments per year, and that was the same in 2023 on 2022. And just for some context, because Tomas is in health, we're very much on the other side of venture. So I work on software engineering tools, security tools, and energy technology, energy hardware like batteries, solar systems, and energy software. So for us, the deployment has been about the same. But you're absolutely right. This asset class. Someone on an earlier panel said it's silly to call some things asset classes. Very silly to call venture capital an asset class, and then to analyze it, thusly. And it looks terrible when you analyze it as an asset class. For us, it's been about the same.
Okay, let me ask Tomas the same question, and then I'll ask you some follow-up.
Well, I'll broaden the perspective a little bit and want to disagree with our previous speakers that the stock market is great. The public companies and private companies, whether it's PE or VCs, are down tremendously compared to under the Trump administration. So if you look at the stock market today, it's breaking records. It's nominal records. So adjusted for inflation, the stock market has gone up 2.5% per year under Biden. That's not a great record. It went up 5 times that during the first 3 years during the Trump administration, essentially. Obviously, you're going to break nominal records the longer you go in time, and that's what's going on right now in the public stock market. On the ventures, on the private side, essentially, I've been involved with, I guess I've made 3 investments the last year, and I'm on the board of all those 3 companies, mostly in AI and healthcare, which were more active, I would say, than the rest of the venture space.
Are those sectors more resilient to an economic downturn, or?
Well, healthcare in general is much more. I mean, if you have a broken leg, you're not going to not go to a hospital because it's a recession. So basically, healthcare is much less cyclical. We call it. How much it co-varies with the overall GDP or the economy, essentially, than many sectors. It's also more subsidized than many sectors. So about 60% of healthcare right now is publicly subsidized, Medicare and Medicaid, essentially, and also CHIP for children. So it's stable money because tax money you can always collect. People have to pay for your service, it turns out, if you're a government, or you go to jail. Which private companies can't do. A lot of private companies would like that power over their customers. They don't have it. But anyway, so the healthcare tends to be a lot less cyclical. And we're seeing a lot of productivity gains in healthcare with the new AI, which is going to make it hopefully a little bit more efficient than we currently have it.
Mm-hmm. And Joe, just to expand on kind of the data and there being that much capital out there. A lot of people also say that, venture capital isn't necessarily an asset class where you just invest in, right? They're the top quartile. Can you hear me? They're the top quartile of funds, and it's all about, picking the companies that are going to give you the best, the highest returns. And, many veteran investors continue investing through downturns at the same pace. So I think you make fair points, but was there anything you did differently in the deals you made last year, or even, the way you approach 2024? Are you doing anything differently with founders or with companies?
Well, I guess 2 observations, and then I want to react to Tomas's productivity point, which I think is really the crux of this thing. One is, yes, investment is down quite a bit this year versus last, and that is a good thing primarily because these are private markets. Every investment is individually negotiated, and that negotiation goes a lot better, in my opinion, for both sides if there is not a gusher of capital trying to make this very same investment, i.e. the New York City restaurant investment market. And that's because you want founders of new businesses to care about governance, and you want them to feel a sense of genuine responsibility to their investors, because you need that if you want to be a good CEO. And you kind of want them to have respect for capital. You don't want them to be wasteful. And even in, as Anthony said, absolute power corrupts absolutely. It's very true. And excess capital, particularly in technology businesses, it's very tempting to become wasteful. And inbuilt capital discipline it's not like hardwired into a very large percentage of the population. So most people need to learn it if they want to do it. And the kind of crazy world of 2020, 2021 really allowed a lot of founders who, are very intellectually honest in their field and with their product to become, I don't want to say dishonest, but to become wasteful, simply because they were able to play investor A off of investor B, off of investor C, and get too much money and too loose of a set of strings on governance. And the code word for that was founder friendly. You'd better make this investment founder friendly. And I never liked that because real grown-ups want to have a reporting structure. And so so what we've changed is we've been able, thankfully, because founders have sobered up and the competition is lower, to kind of go back to very plain vanilla corporate governance structures, which is not fun stuff. I did go to law school, although I never practiced law. Unfortunately, I did take corporate law, and I've now spent a lot of time on corporate governance. And now founders will generally accept this kind of stuff. Not just because you're forcing it on them, although in some cases you are, because they might not have another alternative, but because they know it's actually the right thing, because it's the thing that all of their, with a few rare exceptions, starting with E, all of their successful entrepreneurial forebears have accepted and done. So we've made that change.
Thanks. Tomas, do you expect to make, new investments this year, or are you going to stay focused on the existing ones that you have?
Well, one big one is coming up, and anyone who has biotech friends or who are in biotech, I would love to talk to you about it. One venture we're doing is with Lloyd's of London. They're going to offer a new insurance product. This quarter, we're launching it this quarter, it looks like. I developed the product for them. I'm not sitting behind the capital, they are. But it basically insures a biotech for a failure of a clinical trial, essentially. So if you spend $10 million on it, so clinical trials is about 2/3 of medical R&D spending in the world. So most of the money spent on research and development goes into clinical trials. So if you spend $10 million on a clinical trial, but the endpoints, that is to say the disease is trying to treat, essentially doesn't work, you get your money back. So that we hope is going to stimulate a lot of medical innovation. Hopefully, this room is pretty young. You're going to benefit from that, hopefully. I'm too old for benefiting from it, but you guys might. So essentially, it's a product that also lends it very usefully to secure debt being offered to biotechs, meaning now a lender can come in and offer a loan to a biotech as opposed to a VC firm stealing 70% of the company. By providing equity, secured loan to the biotech that basically doesn't exist in the biotech industry currently, where the lender now gets paid by Lloyd's in case the trial fails, and usually in that case, at least if it's a single product biotech, it's a bankrupt company essentially. So we're hoping to infuse a lot of secured debt in this industry by this new product. So that's taking most of my time, and it's going to be launching soon. So even if you're not in biotech, let me know if you have friends who are.
And where is that company based?
It's in London. I mean, it's Lloyd's of London who is launching it. There's the big, I don't know if I can talk about it, but one of the biggest PE firms is putting in equally amount of money into the venture. So that's going to be based in New York.
Okay. Is there anything more in terms of timeline you can discuss?
Well, yeah, I mean, it's supposed to be European launch on March 1st. U.S., because of the regulators, we have regulators by state here in this country. Insurance is regulated on the state level. They're taking a little longer, so it's about July 1, apparently, in the U.S.
Okay. Joe, talk a little bit about, your energy is the one focus of your investments. Talk a little bit about where, what you see as the most interesting opportunities, as well as the companies that you're already involved with.
Yeah, healthcare is a huge industry. It's pretty much the biggest in the world. The only one that's a little bit bigger than healthcare would be energy. So we're involved in trying to build companies that make energy cheaper and be more distributed. And I don't know curious, since I spent all of my life in Northern California, can you guys raise your hand if you have an electric car? I'm just curious what the percentage is. Yeah, it's like 3%. That's funny. So of course, California, right? It would be 70% or so. Florida Power and Light is an excellent utility. You guys have really superior electricity distribution, and your cost should be about 15 cents per kilowatt hour, which is the overall U.S. average cost. The problem is that is decreasingly sustained. By the way, I have very robust libertarian conservative credentials. I'm not anti-fossil fuel, but I invest and work very heavily on solar technology, distributed generation, microgrid, and battery technology, because I think that is, in fact, the way that energy becomes cheaper for people and more resilient. So that 15-cent thing in Florida, what it is in Northern California, so you guys are happy you live here, is about 45 cents. So it's a big, that is a 2.5x of your monthly electricity bill. That's what it is in Northern California for everyone. They're trying to make it now income segregated. If you're high income, your electricity price is this, but if you're low income, your electricity price is this. That's a real problem, because families depend on electricity and will increasingly depend on electricity because your heat source is slowly moving to become more likely to be electric than gas, and your transportation source is slowly moving to become more electric than it is fuel. So if that's happening, we'd better have cheap energy for people and businesses to live their life, be happy, and be free. But the only way to do that right now is by buying energy from your grid and at the price that they tell you you're going to pay. And very broadly speaking, I don't think that's fair. And I think that that's a lot like when you have to lease time on a computer, a mainframe computer at your university, if you wanted to do a complex calculation or send an early email. That wasn't fair either. That meant you had an immense sort of tower to clamber over in order to leverage your own worth as a person, your productivity. Have to clamber over this tower of getting into a university and getting a piece of time to use a computer. Of course, it sounds absurd, but that was the reality for the first 20 years of computing. That is the reality today with energy. It's why I work on improved solar energy technologies, because it's the only way that people can actually become their own, you could say, oh, you can install a generator or something. That's not, the only way to make your own power, de novo, new power, new electrons that didn't exist on Earth the day before, is with solar energy. It's also the cheapest form of energy in the world, including nuclear and other cheap stuff. So I work a lot on that. I work a lot on novel battery technologies to store the energy, because the only weakness of solar, the advantage is it's extremely cheap, it's clean if you care about that. I don't think fossil fuel guys are evil, but it's clean. And it's already where you need the energy. It's already at your house or your building. Those three things are insurmountable advantages, and it's going to win. There's about a terawatt of solar being built every year, and it's winning. Of course, the only weakness is it doesn't work at night. So that's why I spend the other part of my time working on battery technologies. And I can talk about that, but that's another piece where we're really squaring off with China. That's led me to a lot of very challenging manufacturing decisions. But those are the two areas of energy where we're investing the most heavy.
I'll get to that in a second, but you raise a way to get into a bit of a policy discussion. Want to ask each of you, Tomas on healthcare and Joe on energy, what type of policy would you like to see from the federal level down to the local in order to foster innovation, to foster, is it just do nothing, the best policy, or what types of things would you like to see?
Well, a lot of policymakers, I think, have not been in the private sector. They've never been to a VC meeting. They've never been to a PE meeting. And in healthcare innovation, which is mostly drug innovation, medical device too, the thing that drives it, like anything else in the economy, is future earnings, right? So the question is, how do you generate future earnings? They're upset that the companies are too profitable they argue. But if you look at the value they create, essentially, the health is the most valued thing on the planet. People care more about their health than anything else, and the economic studies that comes across as very high valuations of health. So if you extend someone's life, in fact, there's studies showing that the last century, the most important thing was to gain in life. We doubled lifespan. That was much more valuable than the growth in GDP the last century, essentially. So because obviously people care about their health more than anything. So it's super high numbers when it comes to what's the value of an extra year of living. So when the companies generate these products, they appropriate extremely small percentages of the total value generated as profits, on the order of magnitude less than 5%. So we want a lot more biotech billionaires out there, for sure. People get upset at that for some reason I don't fully understand, but we want people to get super rich on biotech because the patients they help, gain a lot more than these guys are gaining, put it that way. So I think policies are actually going in the opposite direction. We had the Inflation Reduction Act, which set price controls on drugs, which is a disaster for the whole supply chain because the VC's funding depends on how much the big pharma make when they distribute a drug, obviously. So it affects the whole, it's part of the reason why biotech took such a dive. It's not the only reason, but it's part of the reason. We have reimportation taking place in Florida, which is misguided. It will not import Canadian prices. It will export US prices to Canada. Because
You're talking about the importation of drugs.
Yeah, from Canada to Florida. The reason is because you're asking a company to ship product to Canada and then compete with itself on price in Florida. Very few companies are interested in competing with themselves on price. They might compete with other companies on price, but they don't want to compete with themselves on price, which is essentially what you're asking them when they're shipping drugs to Florida or to Canada to come back cheaper into Florida, essentially. So Canada is about 4% of brand sales. Generics is about 95% of prescriptions, but brand sales is obviously more expensive. Canada is about 4% of US brand sales. No manufacturer will try to kill their US market by trying to capture a Canadian market at 4%. So what will happen is either they stop shipping to Canada or they force the Canadian governments to raise their prices if it's going to come back into the US. So I think that's extremely misguided policies. It sounds good. You're fighting big pharma. I don't know why you want to fight big pharma, especially not since they saved the planet after COVID. Not only did they save health, they also saved the economy in some sense. So I think I don't think that they're actually viewed worse than the cigarette companies in DC. Even though the cigarettes kill people, these guys make them live longer. And I think it's kind of absurd the way it's currently. They have a very bad managing of marketing of their industry, I think, because it's so backward the way we view these companies.
Okay, and Joe, on energy, your perspective, there's been a pretty active government certainly in solar. How would you answer that? What kind of policy would you like to see?
Well, my rule for companies is you don't get to count government incentives in your annual operating plan. You don't get to get a budget approved and get an AOP approved and get a BOM approved for the product that you're going to build when something at the bottom of that spreadsheet is, and by the way, we're going to get X tax credits back from Section 45X of the Internal Revenue Code. That's illegal in any company that we invest in for the simple reason that those, the government giveth and the government taketh away. The rooftops, just parenthetically, rooftop solar subsidies were dramatically slashed to almost zero in California last year. And who brought that proposal to the Public Utilities Commission to do it? The Natural Resources Defense Council. for whatever idiosyncratic, internal politics reasons they had. So no, we don't rely on that stuff at all. I do just want to make the point about domestic international manufacturing and importation. The government with the IRA and the CHIPS Act, both of which do the opposite of what they say they're going to do. The government is trying to get semiconductor fabs and battery fabs built in the US by showering money from on top at people who are going to hopefully do that, and it's not going to work. The problem is that it's too expensive to operate a manufacturing business in America, and they've made it too expensive to operate a manufacturing business in America. It's what they did for the last 30 years. So sprinkling a little money on top to start with is not going to help at all with that. And so you're going to, in fact, just today, Intel paused its Ohio fab. They're all going to be paused because they don't make money. This idea of just showering taxpayer money rather than fixing the underlying stuff, which is labor and regulation and environmental, that's what needs to be fixed.
Okay, great. Does anyone have any questions? Sorry, I didn't leave much time, but anyone, just raise your hand. Oh, yeah, go ahead. Is there a mic or?
There you go.
Okay.
How you doing, guys? My name is Andre Villarreal, based here at a fixed income management firm. So please apologies if I've used the wrong terminology here. But Joe, after I'd love to connect because on the battery dynamics, I have a good childhood friend that he travels between here and Austin. He started a 3D battery printing. I have no idea how that's possible, so we should catch up after. It looks like we've mostly talked about several sectors. I'm curious to get your thoughts on the dynamics of the SaaS world. So, I mean, you could probably just within this room think everybody's probably been impacted by the development of kind of SaaS and the evolution of it. And with regards to AI, I've seen things that suggest there could be some pretty big disruption. The whole idea, by the way, for background is rather than renting whatever software that has been built that provides value to your company or whatever you're doing, instead you could pay a one-time fee and have it built. I don't know about this world. I've heard it could be pretty disruptive. I just want to kind of get your thoughts on that, if you kind of have any in that sector.
Yeah, I'll just give a quick thought on SaaS. So SaaS is probably about half of our investment activity. So I talked a lot about energy stuff, but SaaS is about half. There's an analogy I give founders who want to start SaaS company. It's very easy to start a SaaS company, right? There is no factory to build to start a SaaS company. And so the analogy I give, now we have 1 minute. All right, so I'll just give you the analogy, and then that'll be the end of my comments, is our favorite Italian restaurant in Palo Alto. I've been going there so long. I know all the details. I know the owner. I know how much money he makes. I know what he nets of his revenue. He's a very successful guy. This is because he has a huge wine list. So this restaurant makes $13 million a year. The owner, very good friend of ours, takes home about $100,000 at the end of all of that. His gross margin on that $13 million is about 50%, which is pretty good in the restaurant world because of the wine. But his net margin is about 1.5%. That's what the restaurant makes. And a lot of SaaS companies, even if they have fancy dollars from fancy VCs, are like that restaurant. A lot of them. In fact, many are worse than that restaurant. So if you're going to start a SaaS company, tackle something very large and very audacious, because you're exactly right. There are a lot of companies that don't quite deserve to make a margin in that business, and what their customers ought to be doing is developing their own solutions rather than buying the SaaS solution. And so we try to be smart and invest over here around developer tools, how to help more companies write more code by themselves. That's sort of how we look at that problem, but I think that's a great observation.
I think we're out of time, so thanks.